Just because you make 6 or 7 figures when self-employed doesn't mean your income will qualify you for a home loan. I've seen self-employed buyers with wildly successful businesses get denied, not because they didn't make enough, but because the way they showed their income made them look broke to the bank. If you don't understand these 5 signs, you could waste months home shopping only to hear denied from your lender, or worse, lose the home under contract. Let's fix that before it happens to you. I'm Andrew Russell, owner and founder of RCG Mortgage, and I specialize in working with self-employed clients, entrepreneurs, business owners, and getting them the right mortgage products and helping them achieve real estate riches. I just closed on a home purchase for a client, let's call him Greg. So Greg actually didn't come to me first. Greg owned a very successful landscaping business. So it turns out Greg had all this money parked at a big bank. So what did Greg do? Of course, he did what all Gregs do. He went into the big bank, he sat with their mortgage loan originator, with the person in the branch, and he went over his qualifications and he went through the pre-approval process. Because in Greg's head, he brought in $80,000 a month. It's about $1 million a year. Should be no problem buying about $1 million house, right? Putting 20% down, which Greg had. Mortgage payment roughly $7,000, throwing darts in the dark here. But if you made, in his head, $80,000 a month, $7,000, less than 10%. What's the big deal? So it turns out it is a big deal in mortgage world. So they, of course, look at his tax returns. So they asked for his last 2 years of his tax returns. And they showed that on his tax returns, Greg had a lot of expenses. So that $1 million in revenue on the top, if you've ever seen a tax return, on the way top shows the revenue. In the middle are all the expenses. He had employees, he had contractors, he had tons of equipment, as you can imagine a high-end landscaper would. And after all the expenses and depreciation and all this cool stuff, rent for his equipment, all that stuff, his car payments, his huge trucks that he had, he ended up showing out of that $1 million, he showed a net profit of $60,000. So as you can imagine, $60,000 divided by 12, because per month is what we look at. It's $5,000 a month. Assuming great credit for Greg, which he had, and no real debt, which he didn't have. He didn't have much debt, which is great. But that $5,000 a month, he only gets credit for $2,500 a month for a max mortgage payment. Now, as you can imagine, especially in New York, $1 million house, taxes could be $20,000 for the year for property taxes plus homeowners insurance. That's around $2,000 a month just for the escrow account. So that only left no more than $100,000 for mortgage. He didn't have $900,000 to put down, so of course it wasn't going to work. Eventually, Greg was referred from his agent, said, hey, listen, you should have trusted me with our recommendation. Obviously, you gave it a shot with the big bank. Call our in-house team, Andrew Russell from RCG Mortgage. So I was able to speak with Greg. And of course, looking at his returns, the benefit was I actually looked at his tax returns. He actually had the previous 2 years, but the current year that was actually due a while ago was on extension. I said, hey, there's some pretty cool programs now that go off a 1-year average. So if I help you structure your returns, it's not help him, it's just speak to his accountant and let him know, hey, you see the previous year, some of these expenses, they affect the ability of this client to buy. Maybe this year he's a little bit more conservative with the IRS expenses that he writes off. It'll help him be positioned to buy a house. And of course, the subsequent years, he can go back to writing some stuff off. This year, maybe his IRS tax debt, his IRS liability will go up. It is what it is. So we're able to help structure, for $1 million house with that amount of a mortgage payment that we went over, let's say $7,000, $8,000. Say he needed $30,000 a month, $25,000 to $30,000 a month. We were able to help him between some of the write-offs to take off some of the write-offs as expenses. He paid a little bit to the Fed side, or he was going to. No big deal. He'd be able to qualify for the house. Now, it turns out, as we were in the process, it went into the next tax year. So the underwriting team, because he filed super late, pretty much down to the last minute. So as it went into the following year, the underwriting team, they said, hey, now that it's the new year, have you filed your taxes for, the preceding year that just passed? Turns out he did. He didn't, Greg. Greg made a boo-boo. He didn't even say, hey, Andrew, not only did I file my late tax returns, I'm filing my most recent year. I'm not even going to show you, which is problematic because we spent all this time, effort, energy, and he was going to have to pay Fed debt and state debt for that 1 year of tax returns. He ended up doing the same boo-boo, but once he did a boo-boo and he filed his tax returns aggressive with a lot of write-offs like he did in the previous years before we helped coach him to help qualify, before when he had all the write-offs, he didn't qualify at all. And he went from trying to get pre-approved to getting declined, to us helping him because luckily, believe it or not, luckily, he didn't file his returns. He was late. So we said, hey, if you don't write off these expenses, although you'll owe the Fed and the state side this amount of money, you'll be able to buy this house, which he appreciated, and having a payment plan for what he owed. To then, as we're getting closer to the closing, disqualifying himself, literally completely disqualifying himself because he filed his returns again, listened to his accountant and not the mortgage team. He was able to write off a lot of expenses. He didn't owe any federal debt and actually got a little bit of money back, but now he didn't qualify. So there is a light at the end of that tunnel. It turns out I said, listen, in a perfect world, the interest rate was going to be 6% on this program. We can get you a rate of 6.25 or 6.5 on a bank statement program. So we completely pivoted. We went to a new lender. We did 12 months of his business bank statements. We looked at the cash flow, and we didn't have to use his tax returns. But if Greg would have listened and he would have alerted us on the banking side, everything that he was doing with his tax return, his interest rate would have been better. And listen, 0.5% in rate could be $200 a month. It's $2,400 a year. That's over what, $60,000, $70,000 over 30 years. So it was more costly. It's always the prudent move to alert your mortgage team that you're working with of all things going on. But again, the fact that there are some of these non-QM programs or a bank statement revenue review as income versus tax returns is a good story for Greg, but not all loans can be saved. And of course, I hear you saying, hey, Andrew, I make all this money. What are you even talking about? Similar to Greg when he walked into the big bank. I make all this money. There's no way I don't qualify. Although I don't do mortgage for a living, and I don't know what you guys look at. I make $80,000 a month like Greg in my business. There's no way I don't qualify. That's not exactly true. He or she, I say this in all my videos, guys, he or she who lends the money makes the rules. And back in the day, their rules were, we're going to go off of the net profit after all the expenses. So although you make $80,000 a month in your head, $1 million a year, give or take, in revenue, they're going to go off of your profit, which includes all your expenses. So even if you have a 1099 for $1 million, they're going to look at what do you write off and look at the bottom line profit number. That's what we look at for your income. Now, good news, there are some other programs, but unfortunately, just because you got all that cash coming into your account every month, guys, doesn't mean that you necessarily qualify. And of course, hey, Andrew, this all sounds great, but my accountant handles that. I have no clue what you're talking about, what goes on. Look, we as mortgage professionals, we realize there's two sides of the fence here. There's the IRS tax liability side. So if you make $1 million a year, and you have expenses, it is your legal acceptable right to write off expenses. And then your net profit is what you pay income tax on. So if you have a brand new truck you had to buy from a landscaping perspective, or there was a lawsuit against your company and you can write that off, or you had some huge expenditure, you're gonna write that off, or marketing or advertising, you're gonna write that off. I get it. You don't wanna pay taxes on $1 million and maybe you only netted $100,000 from that million. I get it for all the expenses, but you always want your mortgage company to work with your CPA, especially around tax time if you're thinking to buy a house and you want to get a loan, because there are still things you could write off which won't affect your ability to buy. But unfortunately, if you go write off crazy, you may not put yourself in a position that you're not able to buy. So it's always prudent to vet your returns. It's a lot of work, but it's always prudent to QC your tax return and say, hey, it's one thing if from an IRS perspective we're saving money. It's another thing if this is going to absolutely ruin the opportunity to buy a house. All right, guys, I'm going to go over 5 specific things. Let's call them red flags, but these are 5 things. If you're self-employed, business owner, entrepreneur, not a W-2 employee, and you're looking to purchase a house, these are 5 things to look out for. So each of them in their own way can affect your ability to purchase. So I'm going to go over all 5 and kind of give you the tea on all of them and what to look out for. Before we do, make sure you go in the description, click the link, and get our self-employed income worksheet cheat sheet. My team spent a lot of time on this, guys. It's free. It's no catch. Not going to blow you up on text to buy some kind of a product. We don't have a product even to buy today, right? So go in the description, click the link, get our self-employed cheat sheet. It's free and it's amazing. All right? So let's go over each of the 5. All right, guys. So let's go over all 5. The first one is write-offs. The second, profit, which is on the bottom of your return. Fluctuations. Do the third, personal bank statements, obviously versus business. The fourth is going to be deposits. You're self-employed. You make good money. How the heck could a deposit affect you? We're going to talk about that. And the 5th is late, being dramatic here, guys, late filings. So sometimes, let's get a G there, our self-employed clients, they file their returns late. Maybe they didn't file them, but they were supposed to file them. Then they file them, don't even tell us, and it affects them. So this is the type of stuff we'll go over. So let's go over each one at a time. So the first one, the write-offs. So if you think of a tax return, Just think of, again, in the case of our landscaper, so we have Greg. Sup, Greg? As Gabby says, sup, broski? So he had about $80,000 a month, right? So let's just call it $960 for the year. If you times it by 12, let's say $1 million a year in revenue. Now that $1 million a year in revenue, from there it gets subtracted expenses and then equals profit, right? This is how you showed subtraction back when I went into school in the Stone Ages. I'm not sure now, there's like all sorts of different ways they show it. This may not even be applicable to millennials, but I hope it works, right? So I think you get it, right? But the profit here, just because you made $1 million for the year in revenue doesn't mean that your profit was $1 million. What if you had $950,000 in expenses? How could you possibly have $950,000 in expenses? I don't know. What if Greg in his landscaping business, what if he had trucks and he had some of his equipment depreciated and he had, employees and he had marketing and he had advertising and, for him to get business, he goes to networking events that cost money. Maybe he did some sponsorships. So the profit on this would be $50,000 for the year. So as you can see, how would that affect him? Over here, just real quick, let's give you the example, the $1 million house, 20%, always put a dollar sign, right? 20% down payment, $800K loan. Let's say that's 56. We're just doing rough numbers here, guys. At 7.5% APR, so rate, $5,600 plus another $2,000 for taxes and insurance. So $7,600 a month, real quick, off $1 million house, 20% down, give or take around a 7% interest rate, 7.5% APR. Closing costs in this program, that's all an APR really means. So $7,600 a month, $50,000 for the year over here. That's $4,167-ish a month. If you had great credit, no debt, you're at a little less than $2,100 a month all in. That's what you qualify for. It's actually less than that. It's a little over $2,000 a month. I rounded up to keep it simple for the non-math people in the room. So as you can see, $7,600 is exponentially higher than $2,100, just won't qualify. But in Greg's head, he makes $1 million a year. I make $80,000 a month. How do I not qualify? It's because of the write-offs. So you have to be very cognizant. If you're self-employed, business owner, entrepreneur, 1099 contractor, all the above, none of the above, but if you're self-employed, in all seriousness, make sure you go over your returns with your mortgage professional because the big word is expenses. The benefit of being self-employed in this country is that you get to write off all this cool stuff and pay tax on this profit number. So Greg thinks he's beating the system. He makes $1 million for the year. He's only paying taxes off a $50,000 income. But although I would assume these expenses are all viable and legal, and it is sensical that he's paying tax off $50,000 for a yearly income, he now doesn't qualify to buy a house. So it just always is the big number one. Your write-offs. If you're self-employed, your write-offs play a huge part in what you actually qualify for. And at least broach your tax returns. Have your mortgage professional look at the tax returns before you file them with the IRS, because once you do, you really can't amend them. It's a super bad look. It opens yourself up for audit risk. I made a mistake. Don't do it. But write-offs are a huge thing. That's number one. Number two, profit fluctuations. So let's bring it over here. So say 2025, right? So in 2023, 2024. Say in 23, the landscaping business killed it. And that $1 million in revenue, it had $300,000 in expenses, and it netted out to $700,000 for profit. Killed it, right? So that's $700,000. It's what, $60-ish thousand a month? That's a lot. That would be more than enough to qualify to buy the house. But since it's now 2025, his 24 taxes, say it showed more in revenue, maybe 1.2, so he thinks he's good. I went from $1 million a year to 1.2 a year. That's not what we look at. And say he had $900,000 of expenses. For whatever reason, it could be a lot of different things. So $300,000 is the profit for 2024. So it's $25,000 a month. Still opportunity to qualify for this, but when an underwriter sees went from 700 to 300, so it went down over 50%, the profit, right? It was cut in half, more than half. They're going to absolutely, I hate hitting the numbers like this, disqualify you, because right now in this regulatory, mortgage, financial environment, if your self-employed net goes down over 20%, so if it was 700, 20% that's 140, so it would have been what, 560? That's the magic number here. And even at that, it's a little bit tough, but it could have been 560, 570 or above, and they'll still ask questions, but it's okay. This income went down over 50%. So even if you just want to use the most recent year to date, they won't allow it because they think, what's happening now in 2025? We won't know until 26 when you file your 25 returns, right? So we're going to go off of zero. We're not going to give you credit for any of this because in our opinion, if it went down 50%, from, if you remember, before I smoked it with my marker, 700 to 300,000. What if that 3 goes down to 100? What if in 26 then that 100 goes down to 50? Declining income for self-employed, because you can't really figure out as a W-2 employee what you're making right now, based on a pay stub, is a huge no-no. So the profit fluctuations, if year over year, even if you make more in revenue, if the profit goes down over 20%, typically the average bearer lender, even in the wholesale space with us, where we have a lot looser guidelines, regardless, if it goes down over 20%, they may give you credit for zero, not even the recent year, zero. So make sure, again, see the common theme here, guys, broach your returns, send them to your mortgage professional to review, otherwise you could have issues here. But number 2, profit fluctuations. If it's over 20%, it may just disqualify you completely and you get credit for zero. The third piece is personal bank statements. So the difference of personal and business, if you introduce personal bank statements for a business, sometimes they compare the two. And maybe you're self-funding the business with your personal account and you're kind of commingling. And it becomes problematic because if you look at a business, although we don't check the large deposits, they kind of want to see, we do and we don't. They want to see that all the revenue coming in makes sense, that it's things that we can actually use, but it's not coming from the personal account because then it's not really income, right? It's not really revenue. If you're putting $100,000 a month into your business, it looks like your business is, that $100,000 is helping the business. But if they keep seeing that, it could affect you on the purchase side or refinance only because it thinks maybe your business is not liquid or it's declining. So just make sure some of the commingling of personal and business, you kind of keep it clean, church and state type thing. Don't differentiate, or don't commingle. But it's always something to look out for. So when you're self-employed, we always look at 2 months of personal, 2 months of business bank statements. And we always want to make sure that the personal is not necessarily funding the business because then is it really revenue? Not really. Could be running at a loss, but on paper, it kind of gets a little bit gray. The fourth piece, going from profit, which transitions perfectly into deposits, is they're going to look at your deposits. And if it's common and customary, the money's coming in. We see a lot of business owners now having Zells come in, or they have checks, or there's actually cash deposits, which is allowed. Landscaping and some of these, type of things could be cash deposits. Do people have cash anymore? I really don't. But it is a thing and it's allowed. But there are some deposits that are not allowed, specifically SBA loans. If you got an SBA loan because your business isn't doing well, they're not going to give you credit for that for assets, right? So the assets to buy a house, the assets for reserves. What's a reserve? It's the amount of months you have left in your account of mortgage payments. So $7,600 if you have $76,000 after you close, that's 10 months of reserves. The bank thinks you're not at much risk because you have almost a year worth of mortgage payments left in the house after you close. But some of these deposits will be disqualified. So if you have $200,000 you need right here to purchase this house, say with closing costs and reserves, say you need $300,000, right? $1 million house, 20% down, plus closing costs, plus reserves, a couple bucks left in the bank so they don't think you're down to your last few dollars buying $1 million house, which is never good. Then if they see a $300,000 deposit from, say, the SBA, meaning a small business association, a small business loan, and clearly it's because you weren't doing well, so you got a loan, they're going to remove that from your assets oftentimes because it's not a true gain in revenue. Or there's other deposits, right? If you get monies from family, you can use it, but you have to source it. If you have huge deposits and you just say, it's cash that I had in my house that I want to put in the bank, a lot of these can't be used. So the deposits, they're not necessarily reviewed with a fine-tooth comb, but you can't just deposit whatever, whenever we're meant to be together. You can't deposit anything into your account without it being questioned. So just make sure in the last 2 months, when using that as assets, guys, and you're self-employed, that you're able to justify the deposits coming in, that it was for either the business income or something that's sourceable and allowed in mortgage. And of course, the last one, the late filings. So you have until a certain period to file your returns. If you don't file your returns, you file for an extension. Then when you file for an extension, there's 2 deadlines typically. There's one for your personal returns and there's one for the business. So the business ones come first. I'm not a CPA. I'm pretty sure I think the business is in September and then the personal comes later. But whatever it is, if it's now December, January, and you didn't file for about a year and a half ago, It's doable, but it's a little bit more problematic because a lot of times they want to see that your returns are actually the returns that you filed by pulling what's called IRS transcript. So it's a transcript. Basically, you go on the irs.gov site, or there's a form you fill out, and then the lender gets faxed from the IRS a copy of the transcript. So make sure you're not, committing any type of F word, fraud. It's a big bad word. We don't really like talking about it. But they want to make sure that what you gave them is actually what you filed. Now the problem is if you file late, especially over 9, 10, a year, months, a year late, a year and a half late, there won't be enough time for the IRS to review your returns because it's not really the right season, and then say they're okay, and then it turns into the ability that you can pull them as a transcript. Sometimes I've seen people that file their returns late. It takes 3 to 6 months for a transcript to be able to come back, meaning the IRS reviewed it, green lighted it, and you're able to then verify or pull it back from the IRS to say, like, this is what we got on the IRS side and it's okay. This is what the client sent. It could take 3 to 6 months, where if you do it in February, March, April, it could take 2 to 4 weeks maximum. So late filings only become problematic, guys, because we want to make sure on the lending side that what you're giving us is actually what you filed, and it could take a long time if you wait. Or worst case is in the case of Greg, at the end, before we kind of save the day with a Hail Mary with a non-QM bank statement program. So the Greg story, if you remember, we actually had his 22 and his 23. Now his 23, right, were actually late. So we were able to help him structure his 23s, and between his 23 and his 22, it turned out that he, from a net profit, he had enough to qualify. Then here comes 2024s that were due early 25, which it was. And instead of when they were due, he had so much PTSD for not filing these returns on time. He had so much PTSD that he just organically went out and filed these. And it was kind of the opposite effect. So we didn't get a chance to look at them. The expenses were as high as they were in 22. So when you added in this year and did a 2-year average, it went down a lot. And as you remember from number 2, if the profit goes down over 20%, it disqualified him. So in the case of Greg, again, the late filings, first he did a late filing, then he had PTSD and he reversed it. He filed too fast, didn't let us review it, and it actually affected his transaction. So these are the typical 5 ways, guys, that I've seen working with thousands of self-employed clients where things could potentially go sideways. Now that you know the 5 ways that you could typically get denied, make sure, guys, you watch our next video, how to stop a mortgage rejection in 25 minutes for self-employed guarantee. I'm gonna go over all the ways you might get rejected, but also all the preventative measures and how we can squeeze out some income for you and how we can help you qualify. So make sure you watch our next video. It's awesome.